A small crack can tell a large story. It can move from a hairline fissure to a closed road seemingly overnight. When this happens, people blame a single cause, like a storm or bad steel. But the real cause often lies hidden, not in the steel or the storm, but in the numbers calculated years before the first car ever crossed, in how risk was priced for that bridge. The price of risk is a powerful, often invisible force. It shapes how a bridge ages, determining if it's maintained meticulously or left to degrade. The story of a failing bridge doesn't begin when a crack appears. It begins in a boardroom, discussing the cost of preventing it. Decisions made there, based on financial models, echo for decades in concrete and steel. Risk becomes a number, and attached to that number is a set of rules that shape our modern world. The people who provide that money, the financiers, the bankers, the investors, ask critical questions before they commit a single dollar. What can go wrong? How likely is it to happen? How much will it cost to fix when it does? Answers bundle into a price, the price of risk. This price is woven into the very fabric of the project. It influences design choices, the quality of materials selected, and the assignment of responsibility for future problems. A higher price for risk can produce a more robust design with durable materials. A lower price can encourage shortcuts. The financial DNA set at conception dictates a project's physical health across its lifespan, determining which vulnerabilities are addressed and which are accepted. At first, pricing risk seems straightforward, a simple ledger of visible costs. But this view is an incomplete map. It ignores the hidden factors and powerful incentives that quietly accumulate over time. These incentives can make some risks seem small and manageable up front, while allowing others to grow into large, unmanageable problems later on. The visible costs are only the tip of the iceberg. Consider a new power plant. Its visible risks, like the insurance policy against a fire, are clear, quantifiable costs. But what about the hidden risks? The chance that fuel prices skyrocket or that new, cheaper technologies make the plant obsolete. These long-term risks are much harder to price, but they determine the true cost of the project over decades. A new road is built through hills prone to landslides. After heavy rains, a landslide blocks it. Who pays for the cleanup? The insurance company. But the real story is more complex. The road's owner buys the insurance. A low-priced policy creates less incentive to invest in preventative measures, so they might choose steeper, less stable slopes to cut costs. They might install minimal drainage, or skip advanced monitoring technology. The insurance price acts as a powerful lever. If insurance is expensive, reflecting true risk, it nudges owners towards safer, more resilient designs. So who sets that price? Insurers set rates using sophisticated models. They analyze decades of historical data, rainfall patterns, geological surveys. They examine the road design, factoring in angle of the slopes, type of soil, planned drainage capabilities. After calculations, they add a margin for profit and for inherent uncertainty. But insurers operate in a competitive market. They must sell policies at prices owners are willing and able to pay. This creates a constant tug-of-war. Visual, lower insurance premium, higher upfront safety investment, diagram. The final price often lands in the middle, a compromise. The loans that fund these massive projects cast a long shadow. Lenders manage their risk by setting the terms of the loan agreement. These rules dictate how the project is managed for decades. A very long-term loan can make a project seem more affordable by reducing annual payments. But this can create an incentive to defer maintenance, as the lender may care more about repayment than the asset's condition in year 35. Loan terms are a hidden mechanism in the pricing of risk. They can promote long-term resilience or encourage short-term thinking. An owner might pick lenient terms to make the upfront finances look better, even if that accepts more long-term operational risk. The perceived cost of risk is lowered on paper, but the actual physical risk to the bridge or road may have quietly increased, only obvious far in the future. Forecasts are a hidden rule governing large-scale projects. When planners assess a new bridge, they use models to predict future traffic volumes. These outputs project the revenue the project is expected to generate over its lifetime. That projected revenue is what attracts investors and secures loans. It's the foundation of the financial structure. If forecasts are optimistic, the project looks highly profitable. More investors will join, accepting a lower return because the risk appears minimal. History is filled with infrastructure projects built on overly optimistic forecasts. When predicted revenue never materializes, owners face immense financial pressure. This pressure inevitably leads to cutting costs, often in maintenance. The flawed forecast leads directly to deferred maintenance and increased physical risk. The numbers in the model create a vulnerability that later manifests as a crack in the concrete. Politics also plays a powerful, often unseen role in the pricing of risk. A government can step in to reduce financial risk for private companies building public infrastructure. By offering financial guarantees or subsidies, they lower the cost of risk for investors. With a government guarantee, a project that once seemed too risky might suddenly look viable, and more infrastructure gets built. A government guarantee does not make risk disappear. It simply moves it, hiding the true cost of a project from immediate view. If forecasted toll revenue does not appear or a major repair is needed, the private owner is protected. The public budget, funded by taxpayers, is the one that has to pay the bill. This shifts the risk from private investors to the public and can lead to projects that are not truly economically viable. Thresholds matter immensely in the physical world, but are often poorly represented in financial models of risk. A small, incremental change can push a complex system past a critical tipping point, where problems begin to grow exponentially. For example, allowing small cracks to form in a bridge might seem like a reasonable way to save money. At first, the cost of ignoring them is zero. But past a certain threshold, those cracks can connect, and structural integrity can degrade at an accelerating rate. At that point, the cost of repair is no longer small. The pricing of risk can hide a danger. Owners might be tempted to gamble that a hidden threshold won't be crossed anytime soon, but the future is uncertain. Unexpected events, like a sudden increase in heavy traffic, can cause that threshold to be reached much sooner than anticipated. The low price paid for risk at the start turns into a very high price paid in an emergency later on. But past a threshold, it can trigger cascading blackouts. The financial models used to price risk often rely on smooth, linear projections. They are not always good at capturing these abrupt, non-linear tipping points. This is a fundamental gap between the financial representation of risk and the physical reality of it. Finally, we see that these choices do not happen in isolation. They often feed back on themselves, creating powerful loops that can either strengthen a system or weaken a system over time. Imagine a city government decides to cut the road maintenance budget to save money for other urgent needs. In the first year, the effects are minimal. But as the roads degrade, potholes form. Traffic slows down. When budget cuts reduce road maintenance, traffic slows. Slower traffic means less toll revenue, forcing deeper cuts. This is a negative feedback loop, a downward spiral. But good pricing of risk can create positive feedback loops. For example, an insurer might offer lower premiums to power plants that invest in advanced monitoring technology. This incentivizes investment in safety, creating a virtuous cycle. This direct financial reward creates a strong incentive for owners to monitor their equipment more closely. With better monitoring, small problems like overheating components and unusual vibrations are detected and fixed early, when repairs are cheap and easy. This proactive maintenance lowers the chance of a catastrophic failure, like a fire, or a major outage. This lower rate of failure means the insurance company pays out fewer claims. With fewer claims, the insurer can afford to offer even lower rates to well-managed plants in the future, further rewarding good behavior. The system becomes safer and more efficient over time. The mechanism is plain to see. A clear price signal from the insurer makes the desired behavior, proactive maintenance, profitable for the owner. The price of risk is not just a cost. It is an active signal that can steer a whole system toward resilience or toward decay. The key is understanding which loop is in motion. You've been watching System Atlas, exploring how the world's systems really work. Share your comments below. See you in our next episode.